Welcome to Get Rich Education. I'm your host, Keith Weinhold. Where do interest rates and inflation actually come from, and where are they headed in the future? One of the world's foremost economists and I discuss this and more, and how it all affects you as an investor, today on Get Rich Education. The company that's provided our listeners with more loans than anyone is Ridge Lending Group, NMLS 42056. You can finance more than 10 single families up to fourplexes. Serving most U.S. states, their knowledge and experience leads to your financial freedom. They're number one in the investment space. Pre-qualify and then chat with President Chaley Ridge personally. Start on your next investment property loan right now at ridgelendinggroup.com. Finally, Total Control Financial gives you checkbook control of your 401k and IRA money to invest in real estate. It's time to get your retirement money into your own checking account, but you've got to avoid the little-known tax that you'll pay with any self-directed IRA. Instead, it's time for the QRP. Learn more and get your free copy of the QRP book by text messaging QRP in all capital letters to 72,000.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Here it is. Hey, welcome to Get Rich Education. I'm your host, Keith Weinhold. Interest rates and inflation obviously have substantial impacts on you as an investor, and this is dictated by moves that the Fed makes. It's been really concerning to many to see that the U.S. government has made a major reversal on interest rates. Last year, the Fed was raising interest rates and destroying money. They were burning money. This year, they've reversed this. They're lowering interest rates and printing tons of money, and it looks kind of desperate. Well, this rate cutting and money printing, both of which are going on at the same time now at a fantastic rate, they're happening even though the U.S. economy is still doing fairly well. And this reversal has occurred so suddenly. It's really this suddenness that has people concerned. Well, what's going on and how does this affect you? Well, we've talked about how inflation is something that hurts savers and benefits borrowers. You're likely to be a big borrower as a real estate investor. The impact of interest rates on you is more obvious. Just roughly, the United States has an annual deficit of $1 trillion and a debt of $23 trillion. Now, I want to make sure that you understand what this means.
1 billion, Gajillion, Fafillion, million.
That's from the Austin Powers movies, Dr. Evil. Yes, there are surely a lot of big numbers flying around when we discuss national monetary policy. So understand that the deficit, $1 trillion in this case, is an annual figure. You can say that this deficit is revenue minus expenses. Now, debt, on the other hand, that's a total accumulated number over the years, $23 trillion for the U.S. in this case. So deficit is an annual figure. Debt is a total figure. To relate that to you, let's say if you had a rough year financially and your annual income was exceeded by your annual expenses by $25,000, that's annual, so that's your deficit. And I'm not wishing this scenario on you, it's just an example. That's 1 year. But we'd also have to say that you've had a rough life financially, so your $25K deficit this year was tacked onto your negative net worth of, say, minus $500K, your debt, meaning that your $25K deficit this year further ballooned your debt up to $525K total. Well, how bad can the U.S. debt get? How bad can it really get before there's chaos or hyperinflation or anarchy or a depression, well, you're going to have some of that answered today as well. I'm going to ask today's prominent economist guest to look into his crystal ball and ask him not only where interest rates and inflation are going to go in the future, but also the direction of the U.S. and world economy. Despite all this $23 trillion in debt that we just keep running up higher, can it go on? Can it just keep going on without any consequences? Our debt has never been this high before, and the deficit, the annual thing, has little precedent at these levels outside of recessions or wartime. So what is going on? Some people thought that America would reach its day of reckoning before we hit this debt level. But life is still pretty good here in the old US. I think that you can measure how good our quality of life is when you look at what some people consider to be problems. Look how easily offended people are about myriad things these days. And as far as problems, what's a big problem to most people? My goodness, that server put too much ice into my wildly overpriced drink that I'm easily able to afford. Or, my gosh, our kid left the garage door open in our 4-car garage for 5 minutes. And you know what happened? Leaves blew inside. Now they're going to need to be swept out. Terrible, just terrible. I mean, these are examples of problems in the United States today. So life must be pretty good. Now, of course, some people have bigger problems than that, and we're going to talk about some of those, but I think that you get my point here. So sometimes you've got to go macro to figure out what's coming next for you as an investor. Last year, today's guest, Richard Duncan, was here, and we talked about higher interest rates. Now, the very next year, we're talking about lower interest rates. Today, I'm not even in the United States, by the way. I'm in a foreign nation from the American perspective. But it's not really too foreign, if you will, because I'm here for just a week in beautiful Vancouver, Canada. Yes, Canada's third largest metro area, checking out the sights and a little real estate too. Maybe it's appropriate that we're having an international show today as our guest is based in Thailand and we're discussing bigger picture topics on the show. Let's talk to him. Today's guest is a classically trained economist by way of Vanderbilt and Babson. He's worked with both the World Bank and the IMF. He's the author of 3 books on the global economic crisis, including the international bestseller, The Dollar Crisis. And that book forecast the global economic crisis of 2008 with extraordinary accuracy. Today, he's an American living in Thailand, and he's the publisher of the video newsletter, which can be found on his website at richardduncaneconomics.com. Welcome back to Get Rich Education, Richard Duncan.
Keith, thank you for having me back.
It's so good to have you here because a lot has happened in the economy. Basically, the Fed's extraordinary monetary policy made a U-turn this year. Now, last year, the Fed was regularly raising interest rates. Everybody out there seemingly thought they'd go higher, including me. And part of the reason, Richard, is because last year, Fed Chair Jerome Powell even told us that interest rates were going to go higher in 2019. And they also destroyed dollars last year with quantitative tightening, but now they're turning that around and effectively printing dollars. So tell us more about this extraordinary U-turn that's been made.
Yeah, so it truly is a historic monetary policy U-turn. And what happened, as you said, a year ago, the Fed had signaled that it intended to continue hiking interest rates throughout 2019, and that it also expected to continue destroying dollars through quantitative tightening, the reverse of quantitative easing. They were destroying $50 billion every month, and that was expected to go on all through this year and into next year as well. And then everything changed. What changed? The stock market fell roughly 20% from the high to the low in the fourth quarter last year. And that destroyed a significant amount of wealth. And that meant the US economy was very likely to slide into recession. The Fed couldn't tolerate a significant stock market sell-off, and therefore it signaled at its January meeting this year that it was going to put further rate cuts on hold, and moreover, it was going to end quantitative tightening much sooner than had been expected. So at that point, the stock market recovered, for a while, and the market waited, and the Fed didn't do anything right away. And so the market sold off again in May. And at that point, the Fed, they were going to begin cutting interest rates, and that quantitative tightening was going to end even sooner than they had signaled. So the Fed started then cutting the federal funds rate in July, and it cut it again the following FOMC meeting, and the third FOMC meeting as well. So 3 times now. Truly shocking thing is that at the end of September or early October, the Fed announced that it was going to once again begin creating money and using the new money to buy government bonds. In other words, they announced the 4th round of quantitative easing.
Effectively printing dollars again.
That's right. So they switched from destroying dollars as recently as July or August, and that ended quantitative tightening. And then the next thing you know, they have completely flip-flopped and started printing dollars again and buying government bonds again. Now, they said that they're not doing this on a small scale either. They are printing $60 billion a month, whereas at the peak of quantitative easing, they were printing, at the peak, it was $85 billion a month.
Back so this is not, to get us out of the Great Recession.
That's right. That's not that far away, 60 billion versus 85 billion. And they said they're going to continue doing this into the second quarter. That's a bit ambiguous, a bit vague about exactly when they will stop. But if they just do it until the end of the first quarter, that means they'll create $360 billion.
You're talking 2020.
That's right. And if they do it into the second quarter, that's almost $550 billion. So that will more than roughly reverse all of the quantitative tightening they did. They will once again have a balance sheet with something like $4.5 trillion worth of assets in it. This is really breathtaking. I mean, I've long expected that the Fed would ultimately be forced to cut interest rates back to zero in the next economic downturn and then relaunch quantitative easing. But they relaunched quantitative easing even before interest rates got to zero. And they did it on a very large scale. And it was so sudden on such a large scale that it was startled even me.
In quantitative easing, which has the effect of creating money, that's a relatively new policy that was unprecedented until that began in 2008 to get us out of the Great Recession. Now they're performing both quantitative easing, which is money printing, and reducing interest rates at the same time. So it's really pretty unusual. And last year, people were giving some credit to Jerome Powell saying, oh my gosh, the Fed is extraordinarily transparent. They're telling us what they're going to do. Oh, well, the Fed was absolutely extraordinarily wrong because they're doing the opposite of what they said that they were going to do now. So the effect of interest rates going down can certainly be good for a real estate investor in the short term, since we buy such credit-based assets. There's this disconnect. I mean, you basically said that the Fed is a hostage to the S&P 500, and it's really a lot of nonsense. The Bureau of Labor Statistics releases, for example, monthly jobs reports and say that they release a bad report because not enough jobs were created and employment goes down. That right there, that's typically bad news for the economy. Well, now here's where things get warped. But the stock market instead says this is good that employment is down because the Fed will now have to lower interest rates in order to stimulate the economy. So the stock market goes up. This reaction is distorted where bad employment news means that the stock market rises. And I think that it's nonsense that the Fed acts as a hostage to the stock market. What are your thoughts?
It is very confusing to the general public. They simply do not know how to interpret what's going on with the economy because everything seems so counterintuitive. They have been taught in general that we have a capitalist economy and that it's driven by market forces. And that was true in the 19th century. That's no longer true today. Today, our economy is directed by the government at the macro level. And the key to understanding what the government is likely to do next and what the economy is likely to do next is to understand that our economic system, our economy, requires credit growth in order to grow. If the US economy has less than 2% credit growth a year, adjusted for inflation, it goes into recession.
Credit growth, expanding one's ability to borrow more dollars.
That's right. When I talk about credit growth, of course, credit is the other side of the coin of debt. So total credit is equal to total debt. And so when I talk about total credit, what I'm talking about is the debt of the entire country, the government debt, the debt of the households, the corporate debt, the financial sector debt, all the debt. If you look back to 1952, anytime the total debt of the country grew by less than 2%, now I adjust this for inflation so that we're comparing apples with apples.
Good.
If it grows by less than 2%, the economy goes into recession. And the recession doesn't end until we get another big surge of credit expansion. That happened 9 times between 1952 and 2009. Now, after the crisis of 2009, we came very close to collapsing into a Great Depression. The credit started to contract. Not only was it slow growth, but it was actually contracting. At that point, the government started borrowing $1 trillion a year or more through running $1 trillion a year budget deficits for 4 or 5 years in a row. So the total government debt has increased by roughly $12 trillion from $6 trillion to $18 trillion. That's government debt held by the public since 2008.
That's an astounding rate.
And it was that increase in government debt that made total debt or total credit keep expanding. And that's why we didn't collapse into a Great Depression. Now, normally, if the government were to borrow so much money, that would push up interest rates. And to prevent that from happening, the Fed started creating money. They created $3.5 trillion and used it to buy government bonds, essentially. And so that financed roughly 1/3 of the increase in the government debt. And so that's how we've managed to stay out of a Great Depression when the crisis of 2008 hit. The problem is the private sector still is not borrowing enough to make credit grow by 2% a year. And even now that the US government, its budget deficit is almost back to $1 trillion a year again. The fiscal year ends the end of September. The budget deficit last year was something like $990 billion. And this year is going to be above $1 trillion. But even with that large increase in government debt, the economy's total credit is still not growing by 2% a year. Credit growth is too weak to drive economic growth. So circling back to your question about the stock market, because credit growth is too weak to drive the economy, the Fed has been forced to resort to pushing up the stock market and the property market in order to make the economy grow. When stock prices go up and the property market goes up, that creates wealth, and people feel richer and in fact are richer, and so they spend more money, and increased spending boosts consumption, and that boosts economic growth. For example, the total wealth now of the American public, the net worth, in other words, all the assets minus all of the liabilities of all the Americans, is $113 trillion. That is up $43 trillion, or 60% from the middle of 2007, just before the crisis struck. So there's been practically a doubling of the wealth since the crisis struck. And why did that occur? Because the Fed slashed interest rates to zero and then printed a great deal of money. And that made the stock market go up. When they bought assets, they created money, bought government bonds. The people they bought the government bonds from, they had cash. Some of that cash went into the stock market and stock prices went higher. Now, since credit growth is so weak, they have to resort to a supplement. In addition to credit growth, what they can do is make asset prices go up. That's why they are a hostage to the S&P 500. If the stock market goes down, it destroys wealth, and that's going to be certain to throw the U.S. back into economic recession, if not something significantly worse. And they're not willing to take that risk. And so that's why anytime the stock market starts to wobble, they're forced to cut interest rates or do whatever is necessary to keep it going higher.
We're talking about the effect that some economists refer to as the wealth effect. Real estate asset prices are higher, stock prices are higher, people feel wealthier, and they're more likely to spend more on consumer purchases and spur the economy, all through this wealth effect.
So what investors need to understand is that the government is managing the economy through driving down interest rates whenever necessary in order to keep asset prices inflating to keep the economy growing. And once you understand these things, that credit growth is essential to make the economy grow, and if we don't have credit growth, we have to have asset price inflation, then that gives you a much clearer framework for understanding what's likely to happen next than just thinking that our economy is being driven by market forces, which it absolutely is not.
Well, let's talk about the reason for why this U-turn occurred. I mean, the Fed so suddenly relaunched quantitative easing 4, and they did it on a large scale so shortly after quantitative tightening ended. So they've begun creating dollars shortly after they were destroying dollars. Why? Why are they doing this?
Quantitative tightening, I believe, started in October 2017. And they did it on a gradually increased it. At first, it was 10 billion a month and then 20 billion a month, and increased until it was destroying $50 billion a month at the peak. And so altogether, by the time it ended, the Fed had destroyed $750 billion. They took $750 billion out of global economy. That left less money in the financial markets to be invested in stocks, for instance. And at the same time, the government's budget deficit was growing. So the government was borrowing more. So this was draining dollar liquidity out of the global economy. And it was beginning to cause problems first in the emerging markets, places like Argentina and Turkey. But eventually it caught up to the US. And in September, there were problems in the overnight repo market. Normally, corporations or banks, if they temporarily need liquidity, there's an enormous pool of liquidity they can borrow overnight through what's known as the repo market. And there's generally no drama going on there. The interest rate is quite close to the federal funds rate. But suddenly, in the middle of September, there was a shock in that market. And instead of trading the interest rates at 2.5%, some people had to pay almost as much as 10% one day to borrow money. And that indicated there just simply wasn't enough money available. At least, let's hope that's all it indicated.
People were bidding up the price of money.
That's right. Whoever had the money wasn't lending it. And people who needed it, and some of them needed it badly and expected to be able to obtain it as they normally do every day, suddenly had to bid up the price of borrowing. And so that sent a shock through the entire financial community. And immediately the Fed had to respond by pumping in overnight liquidity through the repo market. Within a matter of weeks, they had injected almost $200 billion of new money into the financial markets by lending it overnight through what are typically known as discounting operations, or now overnight repo operations. And they extended some loans for 2 weeks as well. These were lending operations. The difference between lending operations, discounting operations, they occur just overnight. The Fed will lend money for a day and then exchange for collateral, and it gets repaid the next day. Quantitative easing is different. When the Fed does quantitative easing, it's not lending money for a day or 2 weeks. It's actually buying an asset permanently until it sells it. That's the difference between overnight lending and quantitative easing. In the case of quantitative easing, the Fed actually buys bond forever until it sells it again. Through the overnight operations, already it was necessary for them to inject $200 billion of liquidity into the financial markets just within a week or two to restore calm to this overnight repo market. 200 billion, that's already the equivalent of 3 months of quantitative easing at 60 billion a month, right?
Gosh.
So there was a shock to the system and they dealt with it. At the very least, they have to acknowledge that quantitative tightening was a horrific mistake. They should have never started destroying that money to start with. They should have expected this to happen. Now we don't know for certain how much longer it's going to continue, but what this does show us, once again, is that our economy is being managed by the government. In order to make the economy grow, they either need to have credit expand or asset prices to inflate. And if credit's not going to grow, then they're going to have to make sure the stock market doesn't fall, because otherwise, if it does, we're going to go back into a significant recession or worse.
So because interest rates are the price of money, when more money gets printed, that price of money, therefore the interest rate goes down because money is more plentiful, and it's really just a supply-demand balance there. You talked earlier about how, yes, our annual deficit is now close to $1 trillion. Does the United States want to keep interest rates low? Because that way the interest rate that they pay on our own national debt is therefore lower?
Of course, the government would like interest rates to be low for that reason, but I don't think that's not the reason that's driving policy. the reason that drives policy is the reason I discussed before. They're not forcing the interest rates down just so that the government will pay a lower level of interest. In fact, it wouldn't be possible for the interest rates to be this low except for the fact that inflation has been for so long.
Right.
Now the 10-year government bond yield is roughly 1.8%. No one would lend the money to the government at 1.8% if the inflation rate were 5%. But it's not. The inflation rate is very low. And the reason it is very low is because of globalization. Globalization is extremely deflationary. In the old days, before 1980 or so, the US didn't have a trade deficit. And so it just relied on its domestic labor pool and its domestic manufacturing capability. And often in the past, if the government spent too much money, or if the Fed printed too much money, then we had full employment and full capacity of our industrial capacity at the plants making cars and steel, for instance. And that would tend to push up prices. But once we started running large trade deficits, beginning in the early 1980s, we circumvented all the domestic bottlenecks in the United States. So we no longer had to worry about running out of labor in the United States because we could hire people in China or Vietnam or Indonesia, people who earn $5 a day. And so suddenly our economy shifted from being a relatively closed economy with a workforce of less than 200 million people to a global economy with a workforce in excess of 4 billion people. Of course, there are young children who can't work. The total world's population is more like 7 billion people. But there are at least 1 billion people who will work for less than $5 a day now.
Right.
And so once we started running these very large trade deficits, inflation started coming down. As inflation came down, then the interest rates have fallen. So back around 1980, the 10-year government bond yield was above 15%. A few months ago, it was 1.5%. It came down because inflation came down. And so that's completely changed the nature of our economy. We now have a global economy with, you could say, an infinite supply of cheap labor and a near infinite supply of industrial capacity. We don't face any inflationary pressures whatsoever and no risk of running out of cheap labor or industrial capacity that would push up interest rates unless globalization breaks down. If we have a complete trade war, tariffs go up on the imports from all countries, then we would be back in the sort of situation we faced in the 1960s and 70s that produced very high rates of inflation in the US and very high interest rates and a terrible stock market. That's what's changed. We're living in a very different environment today than we did before 1980 when trade balanced.
Well, now that we're printing money on a massive scale, what are the big risks for investors now? And I'm going to ask Richard to look into his crystal ball. What's next for the economy, the real estate market, and the stock market when we come back? This is Get Rich Education. I'm your host, Keith Weinhold.
Would you like to know the easiest way to create wealth and passive income with real estate? This is Marco Santarelli with Norada Real Estate Investments. Now you can access the best deals without the stress or hassle of having to find, renovate, or manage those properties. We save you time by providing you with passive income investment properties in some of the best U.S. markets. Learn more by downloading your free copy of The Ultimate Guide to Passive Real Estate Investing. There's no obligation and nothing to buy. Simply visit passiverealestateguide.com and get your free copy today. That's passiverealestateguide.com.
Countless property investors get killed with maintenance costs, but that's far less likely when you buy brand new construction. Let me tell you about JWB Real Estate Capital in Jacksonville, Florida. They pioneered the build-to-rent model where you can invest in new construction, turnkey rental properties. That's why JWB was featured on the front page of the Wall Street Journal. To learn more and see inventory, go to newconstructionturnkey.com.
This is Profit Boss Radio's Hillary Hendershot. Listen to Get Rich Education with Keith Weinhold and don't quit your daydream.
Richard, we're back. This is Get Rich Education. I'm your host, Keith Weinhold. Richard, talk to us about, with this U-turn that government policy has undertaken, what are the big risks for investors now?
Well, one risk is the fact that asset prices are already very stretched relative to past norms. For instance, I mean, we know the stock market has recently been at a record high, but another way of looking at this is through something that I call the wealth to income ratio. And what this measures is the household net worth, which I mentioned before, $113 trillion. So household net worth, in other words, wealth, divided by disposable personal income, in other words, income. So it's a wealth to income ratio. This wealth to income ratio is at a record high. The average since 1950 has been about 550% on this wealth to income ratio. In other words, wealth was 550% of income. Well, now it is 690%. So that's well above where it was during the NASDAQ bubble. In the NASDAQ bubble, it got up to 620% and then popped and went back to the average.
So at 690%, one's net worth is now about 6.9 times their annual income. That might be another way to say that.
Of course, not everyone's, but as the country as a whole.
Right.
And so that's far above even where it was in 2007, the previous peak, when it was 670%. Well, now it's above 690%. So that's telling us that wealth is very stretched relative to income. And why that matters is there's a limit as to how high wealth can go relative to income, because people need to earn enough income so that they can pay interest on the money that they have borrowed to buy their assets, like their homes or their stock portfolio. So if wealth becomes too high relative to income, then it becomes impossible for the people to afford to pay interest on the money they have borrowed to buy the assets that form their wealth. So that tells us that asset prices are stretched and vulnerable to a correction if anything goes wrong. And that's why the Fed is so concerned and had to, in part, explains the reason why they've had to start going back to quantitative easing so abruptly, is because asset prices are already vulnerable, and if anything begins to go wrong, they could quickly fall. So that's a risk. Asset prices are stretched. Another risk is something quite different. China's economy is slowing very rapidly. Now, China had an enormous economic bubble even before the US-China trade war started. And now the trade war is certainly making things harder on China's economy. Before 2008, it was the US economy that was the driver of global economic growth. Every year, the US would import more and more from the rest of the world, and that benefited the rest of the world. That all ended in 2008, and China stepped in, and China expanded its credit growth enormously over the next few years, and China began importing more into China. Chinese imports were growing more rapidly than US imports. So China became the new global driver of economic growth. Well, now that's changed. Now imports into China are no longer growing at all. Chinese imports have been dropping practically every month now for more than a year. On a year-on-year basis, China's imports are contracting. So this is very bad news for all the countries who have benefited so much from selling to China. Germany, for instance, is now in recession because its exports are so weak, because Chinese demand for German equipment is weak. And similarly, Australia's economy is suffering because, for the same reason, China's buying fewer commodities from Australia.
It's had a ripple effect through the world.
That's right. So essentially, the global economy is in recession now. And what that means is that there are fewer investment opportunities around the world than there normally are. Consequently, people tend to borrow less, because why borrow unless you can invest it somewhere profitably? And so with less demand for borrowing, that explains why global interest rates plunged so suddenly and sharply starting in May this year. Back before May, the 10-year government bond yield had climbed up to 3.25%. Well, now it's less than half that. It was a very sharp and sudden plunge, not only in the US, but around the world. Now, so in one sense, this is a problem, of course, because it's bad on corporate profits. Corporate profits in the US are, they say, in a profit recession, which is not good news. But on the other hand, at least the lower interest rates mean mortgage rates are lower, and that provides some support for the property market. But there is a danger that if this trade war continues and becomes more intense and tariffs rise further, that the global economy will become considerably weaker still. And that will make it a much more challenging policy environment for the US government and the Fed to deal with.
So let's get out your crystal ball, Richard. Look into it and tell us what's next for the United States economy specifically. Maybe it doesn't portend well that you have moved from the United States to Thailand, but tell us what you think's next for the real estate market and the stock market, especially in any other indicators in the U.S. economy like interest rates or inflation. What's next? Where are we going?
So I think what investors can expect is that if we do, for whatever reason, see a downturn, a significant downturn in the stock market, the Fed will take steps to try to make the stock prices go higher again. So it's clear that the U.S. economy is weakening. It hasn't been growing very strongly this year, averaged roughly 2% this year. That's not bad, but it's likely to become weaker than it is. But it's not at all certain that it's going to go into recession within the next 12 months, in part because the interest rates have fallen so much already.
Yeah.
And now the Fed has relaunched quantitative easing, and that's going to support the mortgage market, for instance. So I think we're going to see a general slowing in the economy, let's say on a 12-month horizon. And I wouldn't expect to see a real significant stock market sell-off, or I should say, if we do, then I would expect the Fed to take action as it did back in December, the last time the market sold off, December and May. Stock market sold off, but the Fed then responded, and we're now back at record high stock prices. So it's probably going to be more of the same.
Is there any chance that the United States adopts negative interest rate policy in the short to intermediate term?
I would say no. I don't think it's very likely that they would adopt such a policy, but it is possible that the interest rates could move very significantly lower than they are now. The 10-year government bond yield is 1.8%. There's certainly no reason it couldn't go below 1%. Of course, in Germany, the 10-year bond yield today is minus 30 basis points. So the rates can go lower, but I don't think the government would purposefully adopt a negative interest rate policy.
That's right, where you pay to park your money because you feel like you would lose less there at minus 0.3% than you would lose somewhere else. That's certainly a bearish sentiment. Richard, we've talked about it before with quantitative easing. Now here we are back with quantitative easing again. Basically, you can say that the government is kicking the can down the road, and kicking the can down the road, it sounds like a bad analogy, and it sort of is, but it's better than just being dead. I mean, it beats being inside a painful depression. So it sounds like more money printing will allow us to kick the can further down the road. But what do you think the government's policy options are going forward after this?
Right. Well, in 1930, when the banks started failing, the government didn't kick the can down the road, and the economy collapsed, and unemployment went to 25%. We had a Great Depression for 10 years. The global economy collapsed, and then World War II started, and 60 million people died. So that's the alternative to not kicking the can down the road, which I'm certainly glad that the government kicked the can down the road in 2008, because here we are 11 years later. There's no World War and there's no depression.
Yeah.
So I'm very happy with the way things have worked, and they can keep kicking the can down the road for a very long time, as far as I'm concerned. I mean, for instance, U.S. government debt now, at its broadest measure, is roughly 106% of U.S. GDP, whereas in Japan, Japanese government debt is 240% of GDP. I mean, Japan, their debt to GDP ratio got to where ours is today. They got there roughly 20 years ago, and they haven't collapsed. So that gives us another 20 years of can kicking. And by that time, we will have quantum computing, artificial intelligence, and genetically expanded lifespans and intelligence, giving us all the more capabilities to solve our problems then, rather than allowing everything to collapse now. So yes, it's far better to continue having large budget deficits and financing them with quantitative easing than the alternative, which is having a depression and everybody dying. So the problem is just quantitative easing by itself is beginning to lose its effectiveness. Because once interest rates become so low, then the benefit of lower interest rates, of course, disappears. Once the interest rates fall to 0%, then you stop getting any additional benefit out of interest rates falling further. So quantitative easing by itself is not going to be enough. It's running out of steam. What it needs is a combination of quantitative easing with even larger government budget deficits. That way, if the government borrows more and spends more, that makes the economy grow.
That's the credit expansion.
That's the credit expansion. So we do have larger budget deficits, but we need to have even larger budget deficits. Let's think about this. We've increased our government debt by $12 trillion over the last 11 years. And has anything terrible happened? What's happened? Have interest rates shot up to 30%? No, they're 1.8%. So there doesn't seem to be any limit on the horizon as to how much further we could increase government debt without sparking a panic. So how about this? Now that we're already back to a point where we have trillion-dollar budget deficits and back to quantitative easing again, we could increase the government spending in a targeted way to have more government investment in 21st industries and technologies, say large-scale investment in biotech, genetic research, artificial intelligence, nanotech, quantum computing, et cetera, and spend this money in an effective way so that it creates new jobs and new industries for future generations and also results in medical breakthroughs and technological miracles that make the lives of everyone better.
Curing cancer, curing Alzheimer's, repairing our infrastructure.
Absolutely. This is what is now available. This is the option that we have in front of us if we just recognize it. We're living in a different environment than we did in the past. And recently, this is something I've been talking about for years, as you know. But recently, this is now gaining traction. Ray Dalio, founder of one of the most successful hedge funds in the world, Bridgewater Associates, has earlier this year published articles saying it's now time to take a look at what he calls monetary policy 3. Monetary policy 1 is when the economy gets weak, the Fed cuts interest rates.
Right.
Well, that only works until you cut the federal funds rate to 0%. Then that necessitates monetary policy 2, which is quantitative easing, printing money.
We're doing both 1 and 2 now.
Right. So we're doing 1 and 2 now. But even 2 is running out of steam to drive the economy. So that takes us to 3, where we have to have a combination of money printing with larger budget deficits, a coordination of larger budget deficits and money printing, which is what I've been calling for. Now this is really going into the mainstream. We have to ask ourselves if we can do this without causing high rates of inflation or any other visible negative consequences. And if we don't do this, we're going to collapse into severe economic crisis. Then why don't we do it? Why don't we do it in a targeted way of government investing in new industries and new technologies in such a way that it will improve everyone's lives and cure the diseases and bring about medical and technological breakthroughs that will generally make everyone on the planet better off?
Hey, if it helps you and I live until age 200, we got to be all for it.
Well, that's right. And if you can make it to 200, there's probably no limit. By then, they will have reversed aging and cured all the diseases.
That's right.
So those are the options available to us, and that seems to be the direction in which we're moving. And anyone who thinks that's a bad idea would have to explain why that's a bad idea. I mean, we already have huge budget deficits. We already have quantitative easing. Let's do this in a way that is targeted, not at spending the money wastefully on unnecessary wars and on too much consumption, but spend the money on investing. And then everyone will benefit and our economy will keep growing far into the future.
Well, it's certainly a positive spin on expansion of credit. Well, Richard is really the foremost expert at explaining interest rate policy and inflation outlooks and monetary policy through his video newsletter, MacroWatch. And he really helps bring this to life and go in depth on topics. Richard, tell us more about your video newsletter, MacroWatch.
Right. So MacroWatch is a video newsletter. In other words, every 2 weeks or so, I upload a new video. It's essentially me doing a PowerPoint presentation describing something happening in the global economy and how that's likely to impact the stock market, the property market, commodities and currencies and other asset prices. And these videos tend to be about 15 to 20 minutes long, and they have a package of charts that you can download. So I would like to suggest that your listeners visit my website at richardduncaneconomics.com That's richardduncaneconomics.com. And check it out. They can subscribe for my free blog, or if they would like to subscribe to MacroWatch, I'd like to offer a discount coupon code that will give them a 50% discount off a 1-year subscription.
Thank you.
The discount code is GRE. And so if they subscribe, they will have not only access to roughly 24 videos over the next year, but they will also have immediate access to the MacroWatch archives, which have now more than 50 hours of video content, including a number of video courses explaining, for instance, monetary policy or China's economic crisis or how the economy really works now. Those are some of the courses there. So I hope your listeners will check it out at richardduncaneconomics.com and use the discount coupon code GRE.
I've watched those videos myself. I've learned from them. They are valuable. It's a very pointed and concentrated self-education. That's at richardduncaneconomics.com. Check out MacroWatch and use the discount code GRE for 50% off. Richard Duncan, it's been great having you back on the show.
Thanks, Keith. It's always a pleasure talking with you. Let's do it again.
Well, with the U.S. running up our deficits and our debt, where is our money going anyway? Well, more money is being allocated to healthcare, defense, and social security programs, and that's partly a function of an aging U.S. population. But will foreign nations just say, hey, I've had enough of this, and they're going to stop buying our debt at some point because they don't think that we're going to be able to pay it back? Well, Richard and I talked about this outside of the interview as well. He says that foreign nations will still buy our debt because rates are lower elsewhere, like in Germany, where they're at minus 0.3%, like we touched on. And a second reason is that nations have a trade surplus. And when that happens, that means that they're holding US dollars and they have to spend those dollars. In conclusion, from our chat today, running large budget deficits is better than a depression. What we can do with that money are things like cure disease or improve our infrastructure, but the powers that be have got to decide to do that with the money. And, this is a more optimistic view than some people have about our deficit and debt. Some light at the end of the tunnel here. Interest rates are low, inflation is low, and there's no reason to believe that that is going to change anytime soon. Well, these are big issues that Richard and I discussed today. You might still have questions. For answers, you can go straight to Richard Duncan's resource. His video newsletter, MacroWatch, again, is at richardduncaneconomics.com. Use discount code GRE for 50% off. Today, we discussed the longer view on what affects you as an investor. Next week, it'll be closer to home and how you can build your wealth in the near term. Thanks so much for stopping by. I'm appreciative of your listenership, and I'm your host, Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.